Hey everyone, welcome back to Corporate Decoder. Today we're cracking open Vince Holding Corp's latest 10K report. It's a fashion company, so get ready for some financial tailoring that might leave you in stitches or maybe just perfectly fitted insights. This report has a bit of everything, a brand sale, new owners, and the ever-present struggle to stay stylish in a tough market. So let's dive in. Before we start, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below for more in-depth discussions. First off, let's make sure we know who we're talking about. Vince Holding Corp, they own the Vince brand and they're in the business of making nice clothes, trying to make them nice everyday clothes. This report is for the fiscal year ended February 1, 2025. Keep in mind their year doesn't end in December like most, so this is their annual checkup. One of the biggest things to note is that in January 2025, a company called P1 Vince Accession Number, which is a subsidiary of PR18 and often means changes. Remember Rebecca Taylor? It was one of Vince's brands, but they decided to wind it down. In May 2024, they completed a nominal sale for $1 of all outstanding shares of Rebecca Taylor Inc. to Nova Acquisitions LLC. So that's officially off their books. To put it bluntly, it seems like they couldn't get rid of this fast enough. A $1 sale is almost unheard of. There was a big move back in April 2023. Vince sold its intellectual property assets related to the Vince brand to ABG Vince, which is part of Authentic Brands Group. This means Vince doesn't own its own name anymore. Instead, it licenses it back. They closed that deal in May 2023. This is a big shift. Now, here is something very important for the financials. The company needs to maintain this licensing agreement. If they don't, the company gets no revenue. Now, let's take a look at some of the risks, and one of the biggest that they say is changes to trade policies and tariffs. They specifically call out the recent increase in tariffs and the potential for more. Here is something else very important. A big chunk of their sales come from just one customer. That means if that customer has problems, Vince has problems. The company has a lot of strategic initiatives planned, but is worried that those initiatives might not work out as planned. A lot of it has to do with those tariffs mentioned earlier. As a smaller reporting company, Vince gets to take advantage of some reduced reporting requirements. This can make the company look less attractive to investors because less information is available about them. Let's get into the numbers. Overall, net sales were pretty flat, $293, $23.45 million in 2024, compared to $292.69 million in 2023. But don't let that fool you. It's what's under the hood that counts. Vince Wholesale, which sells to department and specialty stores, actually increased by about 10.5%, going from $149.605 for Fry, $9.145, so means the direct-to-consumer is down. Their direct-to-consumer segment, which includes their own stores and online sales, dropped 10.5% from $143 in $9 million to $123 $9 million. People are not coming to Vince directly. This is not ideal. The good news is that their gross profit increased nearly 9% to $145.7 million in 2024. They are spending less on making the clothes and selling them for a higher margin. That being said, let's take a look at the gross profit percentage. And here we can see that as a percentage of sales, gross margin went up from 45.5% to 49.5%. A gross margin improvement was partially offset by the unfavorable impact of royalty expense with ABG Vince, as royalty expenses were not incurred for the full duration of the comparative period. This means that the new licensing agreement cut into profits. Okay, so there's a $31.27 million impairment of goodwill listed on the form. Goodwill is an asset that's an intangible one that a company acquires when it buys another company. A goodwill impairment means the asset lost value. So what does it all mean? As a result of the P180 change in ownership, this was written down. These expenses increased a bit, $3.5 million more, or 2.6%. Totaling $138 million. It seems like the company is a bit more conservative with expenses, but is spending slightly more on rent compensation and marketing. There was an increase in rent because of lease modifications, whatever that means. Net interest expense decreased considerably, mostly because in 2023 they terminated the term loan credit facility, which cost them $1.75 million in write-off costs and $553K to pay it off. Here is the real kicker. They swung from a $20.5 million profit in 2023 to a $23 to a $23.43 million negative swing year over year. That is no small thing, but it is a pretty complicated change given the goodwill write-downs, termination costs from loans, as well as gains from selling intangible assets. It's a lot to unpack at change. Given the goodwill write-downs, termination costs from loans, as well as gains from selling intangible assets, it's a lot to unpack. At the very end, we see the most important numbers. The company is reporting a loss of $19 million in 2024 from a gain of $25 million to 2023. For a company that is trying to turn itself around, a big swing like that needs to be addressed. The numbers are not looking great. Looking at how they're handling money, the company increased their net cash provided from operating activities of over $20 million. So they did a much better job at making money than they did in the year prior. They did a lot of financial restructuring. They paid off the old debt and took on some new debt. Overall, in 2024, they had $39.8 million available under their revolving credit facility. It seems like the company is comfortable with their debt situation, but also has a lot of rules on what they can do with that money. One last point. They remind everyone that they are a smaller reporting company and they intend to take advantage of certain exemptions. This means they will disclose less information than other companies. There were some new people brought onto the leadership in 2025. Keep an eye on these names to see if they can change the future of the company. All in all, it's a mixed bag for Vince. Sales about the same, but a net loss is pretty bad and they had to get rid of a major brand and fire. Sailor, a new owner might fix the ship, but they have to navigate tricky tariffs, maintain their licensing agreements, keep their few major customers happy and deal with the overall economy. What do I think about Vince? I think they have a tough climb ahead. They may be good at making fashionable clothes, but I am skeptical of their business dealings. The financials are a bit too complicated and the core business isn't doing gangbusters. But hey, maybe the new ownership will be able to turn things around. The fashion industry has been revived more than once before, so anything can happen. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.